Hello. Thanks for joining our session today on Say Yes More, how to help your bank serve more customers, and actually how to help your bank earn more business. My name's Kevin Wood. I'm the president of the Flexent division of Chesapeake Bank. I have 25 plus years experience in the industry of alternative financing, and we've been very successful at Chesapeake Bank, offering it to a lot of companies. Also had Robbie Fawcett, but we're having technical difficulties currently, but he's our director of sales, and again, 25 plus years of experience in the industry. And you would say, well, that just sounds like they're two old guys, but they're two old guys who have been doing this for a long time and have been able to help companies and banks get more business. So thanks for, again, joining, and hopefully we'll have some good information for you guys. And then if we can help in any way, we'll send some contact information out at the end. But we're starting with Say Yes More. How can your bank serve more customers? And not just serve more customers, but also retain your existing customer base. As the economy is changing, tariffs, things like that, businesses are reacting, and this is a tool that can help you not only earn new business, but retain your existing customers. Now, I'll start off with just a question. Have you had to turn down what you thought was a pretty good deal over the last 6 months or the last 12 months? Kind of the business was doing everything right, but they just didn't fit your banking criteria and your lending model. What do you do with those? And then, at this point, now that we're at the end of April, you've got financials coming in. You've got tax returns are finished. You're starting to get internal financials or tax returns from prospects and customers. And you're trying to say, where are they? What's going on with their business? Are they doing well? Are they struggling? How can we best help them with our bank and our products that we have? And when you're looking at those financials, you can see the cracks. Where are they doing well? What do they need help with? Are they too heavy in debt? Are they growing too fast? Are they taking on too much inventory to try and stockpile before the price of inventory goes up? So you're looking at these financials, you're looking at your customer base, you're looking at the markets around where your bank is located, and you're saying, how can we help our customers? And then you may have one of your customers who walks in and says, I've had some losses last year, but things are finally starting to turn around. Can you help me with working capital? Or one of your customers needs a line of credit to take advantage of some opportunities, but they don't really have any real estate to use as collateral. And a lot of community banks are looking generally at commercial real estate as the basis for what they're doing and why they're doing things. And they don't really look at things like inventory or accounts receivable. What if one of your customers comes in and says, I want to retire. I'm tired. I'm going to sell everything to a long-time employee. What are your responses to these kind of questions? If you got a manufacturer who finally got the contract that they've been wanting forever and they need working capital, but you're pretty much leveraged up on their building and their equipment, how can you help them take on the new contract? You've got a young person in your community who's done everything right, and they finally got a contract with a big, slow-paying customer. How do you help them? Or, one of your customers comes in and says, I have the opportunity to double my business, but I need a $500,000 line of credit. And you're like, I can give you a $75,000 line of credit. These are all scenarios that we have seen over the years. They kind of challenge what you have available to offer. And there's more and more and more. We've been doing this for, like I said, over 20 years. And you can see just these different scenarios that are running past the screen. How do you help those folks? What do you do for them? And on top of all this, their business needs, but you've got the bank that you're working for that's saying, you've got some external pressures because the banks are saying we need more C&I lending, but it has to be real estate based, which is really not C&I lending, but we'll call it that. You've got these regional banks and some of the national banks that are coming in with some different product sets, some fintech products maybe, or an out-and-out fintech provider who's doing these loans online in 24 hours or less. They've got some great technology, but they've also got some really expensive pricing, and they've got some really harsh rules. And do you want your customers to have to deal with that? On top of all this, you've got all the regulatory burdens. They were going harsh, now they're kind of slowing back down. Where do you go with all these regulatory concerns that you've got as a community bank? On the other side, you've got your normal dependence upon commercial real estate. You can leverage that 10 different ways, but how do you help your customer if they don't have that? Your bank may be tightening credit standards for whatever reason. What do you do with that? You want more non-interest income. And then you've only got really 4 or 5 products that you can offer to a customer. You can't really offer a full suite of solutions. So you've got all these internal pressures, external pressures. You've got the business landscape changing almost weekly with some of the things going on in the government. What do you do? A lot of banks, they start coming back with, well, we've got this that may be able to help you. We can leverage your real estate. We can look at, a co-signer, co-borrower. What can we do? We're going to offer you something that we have in our wheelhouse that might be able to help. Or you might say, let's just, we're going to offer you what they call the top drawer ABL, where they kind of have an Excel spreadsheet in their top drawer, and they use that to kind of sort of do an ABL, but not really, and just hope that when it comes exam time, the examiners don't pull that loan to look at see how you're managing it. That is an option that some folks use. Or you can just say, is what's your house worth? What's your car worth? What's your equipment worth? Can we squeeze out some additional collateral some way, somehow, to kind of put together what you really need? So you don't need a loan on equipment, but we can use the loan to get you the working capital you need to take on that job. And then last, a lot of times bankers will say, I can't help you. Why don't you go online? That's kind of the wild, wild west these days. A lot of options out there, a lot of very expensive, a lot of onerous options. But sometimes that's what you do. You send them out and say, good luck, go find an option. You've got all these different scenarios, and you're saying, can't get a deed on your house because they're renting. They don't have any equipment because they're all laptops. They don't have any rich relatives that can co-sign. What happens then? A lot of times you just lose your customer. That they go down the street. You lose the relationship. You lose the revenue that you've got from that company that you've worked with. You helped them start from nothing and build up. They want to stay with you, but you don't have enough options to help them out. So what do? Well, our solution, our recommendation, is to preserve the customer relationship and preserve the profitability is, for us, Flexent. What we offer is we are a community bank, and we help other community banks meet the needs by basically plugging in the gaps that most community banks don't offer. So we have a nationwide presence. We help community banks, we partner with them to plug in the gaps on working capital, inventory financing, things like that, and we allow the community bank to take on the stuff that they're really good at. We're a wholly owned subsidiary of Chesapeake Bank, which is a state chartered bank in Virginia. We are actually celebrating our 125th anniversary as a bank this month. 1.6 billion in assets, and we've been doing this nationwide since 1995. So we have a really good reputation. You can see we're not in California. Some of the state laws out there we have pulled out of the state of California, but the other 49, we're happy to help. What do? Our product is really helping companies that just need faster cash flow. Typically, companies that are growing 10 to 15% or more annually don't fit traditional lines of credit and don't fit term debt. We plug right into that space, and we help them grow from point A to point B. We help companies with slower paying customers. You may have customers who are working with companies like InBev or Honeywell. It's a 130-day pay, take it or leave it. It's really hard to pay payroll and cover your vendors and do your business for your company if you're not getting paid for 4 months. We work with startups or newer companies that don't have 2 years of tax returns. But if they have a really good customer base and a really good program and a really good sales, we can help. And then we help companies that have had losses. Over the last few years, we've watched trucking companies who were kind of stable, took off like a rocket during COVID, and then crashed after COVID. And it's very hard for a traditional bank model to help those companies. We've seen the staffing industry during COVID take off like a rocket. And then after that, the money kind of dried up. So there's a lot of different companies, a lot of different industries that have been affected up and down. And those are really hard to bank under a traditional lending model that you may have. We can help with the volatility. Who are the best fits for what we work with? And you may have these kind of companies in your market and you don't even reach out to them, but we can help. Staffing companies. Typically, they're in lots of small communities, lots of large cities around the country. They have weekly or biweekly payroll, but they don't get paid for 30 to 60 days. They always need this kind of financing. They are very rarely a good fit for traditional bank financing. IT consulting, same scenario. Their biggest asset on their balance sheet is their payroll. Transportation companies, I mentioned the trucking industry. 70% of all trucking companies in America use alternative financing, not traditional financing, to fund their growth. Manufacturing, wholesale distribution, those are all companies that really can benefit from speeding up cash flow and getting paid the day they invoice rather than waiting 30, 60, 90 days to get paid. But by the same token, who do we not work with well? We typically don't help construction-related companies, mainly because of some of the laws, mechanics liens, things like that related to that. Third-party medical, which is Medicare, Medicaid, there's just a lot of rules, and we don't do well with those. Progress, advanced billing, those are technically not receivables, so we typically can't work with them. We don't do consumer, and we don't do foreign. But almost every other industry you can think of, we do. Just the ones I mentioned are some of the better fits for what we do. So what does Flexent offer? We really have 3 products. We have AR factoring, accounts receivable factoring, freight factoring, and we have small ticket asset-based lending. And I'll just go through each of those kind of quickly. For accounts receivable financing, we can work with companies that have accounts receivable balances from $100,000 up to about $5 million. It works a lot like a line of credit, but we work it through a purchase sale agreement versus a loan agreement. And there's some legal benefits to us and to the company that while we do that. It's very scalable. It's very flexible. We can grow very quickly with customers. And we are about the same cost as if they accepted credit cards. Every time I work with bankers or CPAs, the first question they ask about factoring is, isn't that a lending of last resort? The answer is, it can be. It's very factoring and asset-based lending are actually a bigger industry worldwide than banking is. Back in the 80s, all banks used to lend on accounts receivables and things like that. They typically, because of bank laws and losses and fraud, they have not. But in large parts of the world, Europe, Asia, Africa, factoring is a very common banking, and it can be here too. It kind of fits a certain niche. There are plenty of bad actors in the marketplace, but our goal is to help companies that are doing everything right. They're growing, they're just working with slow-paying customers. They're positive cash flow, but they just need more working capital. The other questions bankers and CPAs typically ask is, it seems very expensive. If you're accepting credit cards for payment for anything that you're doing, we're less expensive than accepting credit cards. So that's how we try and look at this, is if you can get your cash 30, 40, 60, 90 days quicker, what is the value of that cash compared to that fee? And that's kind of how we work. So it is a great tool for the right business. We think it fits 10 to 15% of the businesses in the marketplace. Could be higher, could be lower, but It is not a lending of last resort, and it is not more expensive than other forms of very common financing. Second thing we offer is freight factoring. When you see the 18-wheelers going up and down the interstate, 70% of them, as I mentioned, are factoring. They pick up the load, they deliver it to wherever it needs to be delivered, they get the bill of lading, they get all the documentation. For us, they can scan that into their phone, and we will give them cash immediately. They can go to the local fuel station, get refueled, and go on to the next job. We have fuel cards that we can help with. We help owner-operators. We do help fleets. We help brokerages. We typically are on the smaller side of what we do. We typically work with companies 1 to 20 trucks. With the bigger ones, we don't typically help just because it's kind of a different animal at that point in time, but up to a $2 million facility. The third product that we offer is asset-based lending. And you're saying, doesn't every bank offer asset-based lending? We offer small ticket asset-based lending. So most of the banks, the regionals and the national banks, do offer asset-based lending. They just offer it to companies that have, do 50 to 100 million to 200 million in annual sales. But you may have a really strong customer in your market that's doing 10 to 20 million annual sales. They will not be able to get an asset-based lending from some of those bigger banks. So our structure is a true asset-based lending product, 500,000 up to about 6 million. We do advances on accounts receivable and inventory, and we also do it by a borrowing base. So it's an actual loan. It's not one of these hybrid cut and paste type products. And it's been a very good fit for companies that want that kind of loan product but just aren't quite big enough. So how do we work with community banks? We work a couple different ways. Mainly it's on a referral basis. You can simply refer your customer to us. We'll collect the financial package, we'll do the underwriting, and we will just pay you part of the fee income. You have no risk, no money at risk, no overhead involved in it, and it's a great way to help your customer meet their needs. We do have some other options where you can participate into the deal if you would like that. Some banks love that model, some don't, but we can work with you to help you keep the customer. You keep all the loans. Because we're a state chartered bank with a small footprint in Virginia, we're not going to come in and offer other loan products. You keep the deposit relationship, you keep the customer relationship. We just plug in the gaps that don't really fit for you. As I mentioned, if you have other, the building loan, the equipment loan, the personal loans, that stays with you. And you could say, well, we could just do this ourselves. Well, you could, but we found in the 5th district here, the Federal Reserve is not very keen on new banks getting into this industry because of the risks. We've been doing it, as I mentioned, for 30 years. So we have a history with them, and we have a good reputation nationally. And do you want to allocate the resources necessary to do this type of stuff and all the underwriting requirements and taking on some unfamiliar risks? I've seen banks who've tried to get into this and they've done okay, but they typically don't cover 1 or 2 bases, and then there's a loss associated with it. So it's better to partner with someone who knows how to do it and just share the revenue and go from there. And why would you work with Flexent versus some of these online lenders? Well, mainly we're a community bank. We're regulated just like you guys are. We're safe. We've been around for a long time. And one of the beauties of what we have is we typically will pass your vendor management or third-party risk assessments because we're a bank, because we're reviewed by internal auditors, external auditors, the Fed, the state. They know what we do, and we typically will pass all of the criteria that your bank may request. So I kind of wanted to go through a real quick example of this, but I do see that there's a couple questions. Let me see in the chat. If you do have questions, just put them in the chat. But I'll give you a quick example of a customer that we worked with one of our bank partners down in North Carolina. They had that scenario that I talked about earlier where a long-term, well-established business was selling to one of their employees. The employee was doing a great job, but just didn't have a ton of assets. And the bank had done several $1 million in loans to them to sell the building and the assets of the company and the business themselves. But the company needed a couple $1 million in accounts receivable financing and inventory financing to move ahead. The bank wasn't comfortable with that much level of debt, and they acknowledged they didn't really do a great job with those intangible type of assets. So they were one of our bank partners. They knew about us. We came in, we met with the company, we set up a facility, we got them up and running. We actually grew the facility from about $500,000 up to over $3 million over the first 3 to 4 years. The company quickly paid down all the term debt, and they performed very well. So after a period of time, 3, 4 years, the bank came back and said, we feel comfortable just taking them back in as a normal line of credit customer. And we turned everything back over to the bank. They still have a very profitable customer, a big employer in their community, and they have been very happy and successful with the relationship of how they've helped them grow and transition to the next generation. They retained all the deposits during all that time. They retained all the loan facilities, and it's just been a great fit. And we have a lot of those scenarios with our bank partners around the country. And I mention bank partners because we have formal and informal relationships with a lot of community banks, where informal, they just say, can you help them? Formal, it's more of a revenue sharing model where we share some of the revenue that we earn on our customers. But that's just one example. We'd love the opportunity to basically, if you have questions, feel free to reach out to us on LinkedIn. Happy to engage with a phone call or just an email. We have done a couple of these in the past, and we've ran across some great opportunities, especially, again, with the tax returns coming out, the financials coming out. We have been the ability to, if they don't fit your model anymore, we can take them for a period of time, and it's been a good fit until they are ready to come back. One of the questions that came up was, what measures do you have to ensure a positive experience? We have, I'll tell you the best indicator that we have a positive experience for our customers. In the factoring industry, the average lifespan of a customer using a factoring service is typically 18 to 24 months. Our average customer stays with us for over 7 years. So I take that to say, we don't have any long-term agreements. We don't require anyone to stay with us or continue to work with us. If they stay with us for 7+ years, we must be doing something right, providing a positive experience. And also our bank partners, we are very cognizant of our reputational risk in the marketplace and our bank partners' reputational risk. So we do take great care to try and help make sure that it's a positive experience. And because we're not contractually locking them into any long-term relationships, it's been a good fit. And that is really it, unless there's any other questions. I do appreciate your time. Thank you for joining in. I hope this was helpful. If you do have questions or thoughts, feel free to reach out. Robbie Fawcett and myself, we'd love to talk with you and see if we can help or just bounce ideas off of us. Happy to do that. Thank you so much for your time, and you guys have a great day. Thanks.